Most business owners do not realize they are standing on the wrong side of an invisible line. On one side of that line is personal credit. On the other side is real business credit. And that line quietly determines how far your company can actually grow. I see this constantly when my team reviews funding files. A business owner builds something real. Revenue is coming in. Customers of theirs are happy. The business is 110% legitimate, but everything is still tied to their personal credit profile. One personal credit issue, one bad month, one large purchase, and suddenly the entire business feels fragile. That is not how scalable companies are built. The businesses that grow into real enterprises separate the owner from the company financially. They build a credit identity for the business itself. Today, I want to walk you through how that works and why crossing that invisible line is one of the most important moves an entrepreneur can actually make. Building the separate business identity. In the early days of a company, most owners rely on personal credit because it feels simple. They use their own social security number to open business accounts, buy equipment, or finance basic business needs with their personal credit cards. Now, at first it works, but over time, that structure becomes risky because the entire company depends on the personal credit profile of the owner. When lenders review funding files, they want to see that the business itself has a real identity. That means a legal entity, its own tax identification number, and financial records and history that show the business can stand on its own. Large companies operate this way by default. When you see a construction company with multiple trucks, tractors, trailers, or a logistics company operating a fleet of vehicles, those assets are rarely tied to the owner's personal credit score. The company itself holds the financing because the business has its own financial profile. That separation is what allows companies to truly scale. The owner still leads the business, but the company becomes the borrower. Crossing that invisible line from personal credit to business credit is what allows an owner to move from running a job to building a true enterprise. The foundation lenders look at. Before a lender ever extends credit to a business, the foundation has to be in place. Many entrepreneurs skip this step because they work, make money. And then they wonder why their funding applications struggle later, even though they're generating revenue. Lenders do not evaluate businesses the way friends or customers do. They evaluate them through underwriting systems and financial signals. If those signals are missing, the file may never move forward and actually be reviewed by a real person. The starting point is forming a proper legal structure, such as a limited liability company or a corporation. Banks and lenders really do not like to lend to sole proprietorships. It looks more like a hobby than an actual company. So forming an LLC or a corporation creates a legal separation between the owner and the business. The company then receives an employer identification number or EIN number from the IRS, which functions like a social security number for the business. With that identity in place, the company can begin building relationships with vendors, banks, and credit bureaus under its own profile, rather than relying entirely on the owner's personal credit. There have also been regulatory conversations around the Corporate Transparency Act that caused concerns amongst many small business owners. Updates issued in 2025 clarified that many domestic businesses are not required to submit certain ownership reporting that people initially feared. The important point is this: creating a legitimate corporate structure remains the first step in establishing business credit and long-term fundability. The hidden map lenders use. Most business owners do not realize that companies have their own credit reporting ecosystem. Just like personal credit has its own bureaus, business credit is tracked by agencies such as Dun & Bradstreet, Experian Business, and Equifax Business. Each of these organizations collects information about how consistently a company pays its obligations. One well-known score on the business credit side is the Paydex score from Dun & Bradstreet. This score ranges from 1 to 100. A score around 80 typically means a business pays its bills on time. Higher scores often indicate payments are made earlier than they're actually due. These signals help lenders evaluate how responsibly a business manages its obligations. But businesses do not start with strong credit automatically. Just like personal credit, the process begins with smaller relationships that gradually build trust, which lead to bigger lending relationships. Many companies begin with vendor accounts that offer net 30 terms. These accounts allow the business to purchase supplies and pay the balance within 30 days. Some examples would be Uline, Grainger, or Quill. Vendors that report payment history to credit bureaus help establish the company's first credit signals. Over time, those signals form the foundation of the business credit profile. Climbing the credit ladder. Once a business begins establishing payment history, it can gradually move up what many lenders informally call the credit ladder. Early vendor relationships often lead to store credit accounts or fuel cards that offer higher limits and more benefits. These accounts demonstrate that the company can manage larger obligations responsibly. As the credit history strengthens even further, businesses may gain access to revolving credit accounts through major retails or business platforms. These accounts function more like traditional credit cards and provide great flexibility for operating expenses purely on the business credit, not on your personal profile. At this stage, the business begins transitioning from simple vendor relationships into true credit capacity. Another factor lenders quietly evaluate is the bank rating of the company. Many business owners have never heard of this, but it's one of the first signals banks review. Bank rating reflects the average balance maintained in a business account over time, as well as number of deposits, quality of deposits or debtors, and how much revenue you're making. Consistent balances demonstrate financial stability as well as affordability. If an account frequently drops close to zero or goes negative, lenders may interpret that as a huge red flag and warning sign. Maintaining stronger reserves in the business checking account can significantly improve how banks view the company when larger financing requests appear later, preparing for larger capital. As the financial foundation grows stronger, businesses eventually become eligible for larger forms of financing. Some companies pursue SBA financing because it offers longer repayment terms and structured loan programs designed to support the growth of small businesses. Historically, many lenders used a combined score called the SBSS score when evaluating SBA loan applications. That score often required a threshold around 165 for an SBA approval. While the SBA has now eliminated that score as of March 1st, 2026, the underlying idea remains the same. Lenders still evaluate credit signals, financial stability, and the overall risk profile of the business. But now they're looking a lot more at debt service coverage ratios and if your net profitability can service the debt that you're asking for. Scaling into larger credit opportunities. As a business continues to grow, stronger financial history and consistent revenue open the door to larger credit facilities. Some modern fintech platforms now evaluate businesses primarily on revenue and banking activity rather than personal credit scores for bigger small businesses. Companies with strong deposits and healthy cash flow can sometimes access corporate credit limits for larger than traditional personal credit lines. Used responsibly, these tools create flexibility for expansion, equipment purchases, hiring and payroll increases, or marketing investment. But just like any form of financing, the goal is not simply accessing capital. The goal is building a structure where the business itself becomes financially strong enough to support growth without relying entirely on the owner's personal credit. Most entrepreneurs spend years building their business but never realize they are still standing on the personal side of that invisible line. Crossing that line into true business credit is what allows a company to grow beyond the limits of the owner's personal finances. The earlier a business begins building that financial identity, the easier it becomes to access capital when growth opportunities appear. If you want to understand where your business stands today, my team can help. Below this video, there is a link where you can schedule a funding strategy session with us. During that call, we will review your company the same exact way lenders do. We will look at your financial structure, your credit signals, and your overall fundability profile. From there, we can show you what capital options may be realistically available right now and what steps would move you closer to larger financing in the future. So if you're serious about building a company that can scale beyond personal credit limits, click the link below and schedule your review. We'll walk through your numbers together and help you build the smartest fundability path forward.